Great to have you on the
Hey,
program. Always good to see you. And I know our viewers absolutely adore you. So can't wait to see what you have in mind to show us, especially with the market having such a difficult week, I'd say.
yeah, it's a difficult 2 weeks, isn't it?
Yes.
And as we were talking before the show in the green room, um, in the bull market, that's when we need to fatten up and make our profits, and kind of like a bear going before hibernation. You need to get enough profits in so when you do get these drawdowns, you can withstand them. But personally, I don't think we're in a bear market just yet. And to kind of illustrate that, I want to just show you some perspective here by looking at some weekly charts. And we'll start with the S&P 500 SPDR, which is kind of like my benchmark for the market. All right, if I had to pick one index to be on a desert island to say is the market bullish or bearish, it would be the S&P 500 or SPY. And if I had to pick one moving average pair, it would be the 50-day or 200-day. Could be EMA or SMA, doesn't matter that much. And then this weekly chart, I'm using 10-week and 40-week. And, it's going to be a little bit late to the party on the bull market when it turns up, and it's going to get out a little bit late when the market turns down. But, we want to catch the bulk of the move. And if you look at the S&P 500 SPDR, it was a straight shot up from the beginning of 2016 all the way there to the beginning of 2018. And then we had a nice choppy correction and then the breakout. And from the 2018 low to the high, it's about 18%. So, I mean, that's a big move. And so the market is entitled to a pullback at this stage of some sort. And so if you look at the 2 weeks that we've had down so far for SPY, it's barely registering. Now we'll get to QQQ and mid caps and small caps a little bit later, but conceivably we could correct down to, kind of 280s, maybe the first level to watch, but we could pull back to this congestion zone and retrace around 50% of that advance. And that would still be within the framework of 2 steps forward and 1 step backward. So that's kind of the position I'm working from, that this is a correction within a bigger bull market. Now we look at QQQ, we can see it has also gotten hit harder, I think. It's had that big bearish engulfing week the previous week and then fell this week. But, maybe this resistance zone and this reversal here and the 38%, it's already near a potential support level to watch. And then you can see I've got 5-week RSI down at the bottom, and it's at its lowest level since October 2016. That's how strong QQQ has been during this advance. But again, I still think this is a pullback because, we had 52-week highs not too long ago. And then we look at mid caps. Now, mid caps and small caps have bore the brunt of selling pressure over the last few weeks because you can see they topped out 4 weeks ago and moved pretty sharply lower. And they're already in that 38 to 50% zone for the retracement. So, maybe back to this breakout zone around 50%. And you can see mid caps are already oversold because 5-period RSI has moved below 30. And then you can see previous moves when RSI moved back above 30. And there's not that many on this chart, but it coincided with a nice low in the MDY. So now that we're oversold, that's what I would start to be looking for, some firmness and some sort of a reversal. And the reason I say that is we all have to make an assumption at some point. All right. And I am assuming that we're still in a bull market. My breadth indicators have yet to turn. I showed those on Monday. The 50-day EMA is above the 200-day EMA for the S&P 500 and SPY. So I'm still playing by bull market rules. Aaron talks about bull market and bear market rules. Well, those are kind of my bull market rules. I'm still playing by those rules. And so that tells me if we get a decline until it, breaks a certain level, it's a pullback. But the problem is, you never know how long these declines are going to go in time or in how far down they're going to go. I mean, if anybody did, we probably wouldn't be here right now. We'd be somewhere else where it is sunnier and warmer and on a beach. But here's IJR. It hit a 52-week high. And so that tells me the long-term trend is up. And it did peak in late August ahead of the others. And it's already retraced a little over 38%. So, it could come back to this breakout zone, to that 50 to 62% retracement area, and still be a normal pullback within a bigger uptrend. All right. And we can see that RSI is oversold, the most oversold since it was in the summer of 2017. It was very oversold in the fall of 2016. So look at that decline there in the fall of 2016. It was pretty steep at the time, and it was like a support break maybe, but then we rallied, and we had another 4-week decline here. And then, of course, that decline at the beginning of the year this year. So the bottom line is I do think it's a pullback within a bigger uptrend. Now, a couple things to highlight here. Finance. And yeah, I think it's kind of dangerous to talk about the finance sector because a couple of big banks are going to report in the next few days, namely JP Morgan and Bank of America. And if you look over here at the top holdings, Berkshire is the top holding, 13%. And they're not a bank, and they're really not an insurance company. I know they do a lot of insurance, but they also buy businesses and let the businesses run themselves, so to speak, and reap the profits like Dairy Queen and such. JP Morgan, 11.5%, Bank of America, 8.37%. Those three account for around a third of XLF. So those are the three to watch. And JP Morgan and Bank of America report in the next few days. But if you look at this chart, you had this big move up to a new high. And then we had the wedge correction, and we're trying to break out. Now we had this big decline 3 weeks ago, but we're back at the breakout zone, and there's a huge battle raging in this 28 area. And if we move below 27.5, 27.40, close below last week's low, then okay, the breakout has failed. But right now, I think the cup is still half full for the finance sector, and I would watch for another upturn. And again, Q off of JP Morgan and Bank of America. Berkshire is trading at a 52-week high. It already hit a 52-week high this month, so it's leading. And JP Morgan's not that far from a 52-week high. So energy, Tom has referenced energy a lot lately, and that's because it is showing some relative strength and a bullish action on the price chart. And again, you got this big move up to a new high. So that tells you the bigger trend is up. So we make that assumption. And then you can see that this is a pullback. Went a little longer than I expected. Actually, I thought we were going to get a breakout here, but we didn't. But it was still a correction within a bigger uptrend. And now we've got a breakout. We're down today, but I think this sector is breaking out, and I would think I'm betting on it to lead in the next few months. So moving down to semiconductors. Now I'm going to open up this chart to show you a little feature we have here called Inspect. And it's real easy to quickly measure the percentage moves that we're getting. And what I want to illustrate is we've got a pretty big move here. If you go from the high to the low and you follow those blue lines all the way over to the left, you can see we're down around 13.5%. And that's a big decline. But then you go back on the chart and you can see, well, earlier this year, we had a 13% decline roughly. And actually, we had two 13% declines. This one was 15%. And then you go back to 2017, we had a couple more, a 10% decline. And then back in the early part of 2017, we had about a 7% decline. But especially since October, it's been very choppy. So this action, yeah, it's negative, but if you see the 10 week is above the 40 week, because that PPO is positive, so it's just a choppy uptrend, and we're coming into what could be a support zone to watch here. All right. But this chop and these deep pullbacks have been happening for two times before. So this is the third one. So it's not that abnormal. We're just living in choppy times. So here's the biotech ETF. And, it's still in a long-term uptrend. This is a 52-week high and a long pullback and then another 52-week high. And okay, we got a big bearish engulfing and follow through. Okay, that's short-term negative, but does it derail the longer-term uptrend? Well, if you look at some of the pullbacks we've had in the past, this was about 15%. This one was about 13%. This one here was 12%. And this one here was 9. So, this one could pull back anywhere from 10 to 13%. If we pull back, say, 10%, that takes us to around 110. You might watch for RSI to move below 30 down at the bottom there for a potential oversold setup. And I'm going to get into those here in a minute when I talk about the chandelier. And just one more chart I want to show you. Well, I'll just go through these for you. Since Tom, I think, gave me till 12:45. He gave me a little extra time. So I featured gold yesterday in On Trend, which is the weekly show that I do here. And it has a Bollinger Band squeeze working. And this is the fourth squeeze in the past 12 months. So the squeeze happens when the Bollinger Bands narrow. And November 2017, we had a narrow. And you can measure the width of the Bollinger Bands using the bandwidth indicator. And you can see it move below 2% there. All right, so the squeeze was on. And this indicator here is percent B. And it tells you the relationship of the close relative to the bands. So when it moves above 1, as it did here, that means you've broken above the upper band. All right, when it moves below 0, that means you've moved below the lower band, as you did up here. But what I want to illustrate here is, the Bollinger Band squeeze is a popular setup and trading strategy, but it's prone to whipsaws because you can see we got the head fake, and John Bollinger talks about these in his book. So it looks like we're getting the breakout and then boom, we get hit. But the breakdown doesn't work either and we move higher. So we got another squeeze and an upside breakout, and it worked for a little while, but then we broke down. And then we got another squeeze here in June, and this one was a dandy. So you had two signals that didn't work, but this one maybe paid for both of them because you moved from like 122 to 112. And now we've got another squeeze working. And technically we've broken below the lower band. So we've gotten another sell signal for gold. All right, but we're in a uncertain period right now, maybe uncertainties above average. It's certainly higher than it was in June and July when the trends were more stable and technology was leading and consumer discretionary was leading. So if you get a breakout here at 115, that would be the level to watch for gold. All right, but right now it's clearly bearish and it's got a short-term bearish signal working.
Hey, Arthur.
Yeah.
A question for you on that GLD chart there. When I look back at the two head fakes that you have in blue at the top, both in November 2017 and then, right there, March of 2018, neither one of those took out the prior price high. So is there, I know, you follow price resistance and support very closely. So when you see a move through Bollinger Band like that, but it doesn't clear price resistance, wouldn't it give you like reason for pause? Because I see like on the last one down here at the very bottom where you're, showing the squeezing currently, you've got that line drawn across there of your price resistance. And it seems to me like it makes more sense if it not only takes out the Bollinger Band to the top, but then also takes out your price resistance. Does that matter to you?
Well, I can see how that would be important because you're right. Here it didn't take out the price high, and here's the high, and we didn't take it out. Of course, the more you wait, the worse your risk to reward gets.
Right.
But I think as far as the Bollinger system, he just uses the Bollinger bands. Of course, it's his indicator, so he only wants to use what he's got.
Right.
But it depends on how close resistance is to the band, I guess.
Okay.
Is what I would say. But it's hard to program in, like if you're going to back test this, you couldn't program in resistance. That would be hard to do.
Right.
So most back testing would just involve the Bollinger Band break. But you can see here, definitely, you broke a support level as well as the band. And that signal worked out a lot better. So here, if you break the band and you break resistance, I think that would be a confirming signal.
Gotcha. Thank you.
All right. So this is just a quick one on natural gas. This is the natural gas November 2018 futures that we have at Stock Charts. If you just search for the caret symbol there at the top left, you'll get all the futures that we cover. No trade here, but man, look at that breakout. Natural gas is broken out of a long trading range. So this is something to keep on your radar for the future, and that could support, what we've seen in the energy complex. I'm also liking biotech still. I mean, look at Jazz. It's down just a little bit today. I view this as a pullback within an uptrend, and a breakout there at 170 would be bullish. And then another one would be Heliad. It's down a little bit today, but its breakout is still holding. So those are some to, I think they're less correlated to the broader market, to technology, than say some other groups like, well, software, of course, is correlated to technology. It is technology. So now I want to talk about the chandelier exit, because I've got this strategy that uses SPY, MDY, QQQ, and IJR to trade mean reversion bounces. And basically, when the trend is up and you're in a bull market, when RSI goes below 30, and I'm at the bottom left of the chart, and then it moves above 30, you get a bullish signal. All right. And you take that signal until it closes below the chandelier exit. So I've got the bullish signals in green, the dashed lines, and then the exit signals, the entry signals in green, the exit signals in red. Now you see that you get the buy signal while you're still below the chandelier exit. And so price has to rise or the chandelier exit has to decline. They have to meet at some point in order for you to get an exit setup. And then the setup triggers when you close below the chandelier. So, there have been some good trades. But of course, if you look at the most recent trade in mid-September, we had RSI moving above 30. And we didn't get above the chandelier. And instead, we moved down. All right, so this is turning out to be a bad trade. And it's going to happen. All right, but I want to explain how the chandelier works, because if you're going to use an indicator, I think it's imperative that you know exactly how it works. And you can go to the chart school and you can read all about the chandelier exit. You can look at the formula. You can plot the components of the chandelier exit, which I'm going to do here. And you can go back and study it, all right, with how does it react, all right, to the different changes in price. So the chandelier is made up of a couple things. First, you have the 22-day high. And what I've got here is the 22-day price channel indicator. And so every time we make a 22-day high, it goes up. And so the 22-day high was flat for 22 days. And then you can see as the 22-day high starts falling at this point here, all right, the chandelier is going to start falling, because the chandelier is the 22-day high and then you subtract one 22-period ATR value from that chandelier exit. So you've got the 22-day high minus one ATR value, and there's your chandelier exit. So at some point, if prices keep falling, that chandelier exit is going to fall. And if volatility increases, that means the ATR is going to go up. So the distance below the 22-day high is going to grow. So at some point, the chandelier is going to come down, and maybe we won't ever get a bounce, but at some point, we're going to cross above the chandelier exit, and there will be an exit signal set up. Now, on this next chart, I'll show you that it can be quite hairy to sit through some of these, because here's QQQ when we had that volatility at the beginning of the year. So you can see we got a bullish signal from RSI in March around the 20th, but continued lower. And so the chandelier finally came down and price finally went up, and we got the cross. And that was a losing trade. All right. But the others have worked out all right. The last one was in September, and you got out with that close below the chandelier last week or the week before. Last week, I think. And now we're oversold again. So if we move above 30 in RSI, it'll be another mean reversion setup. Now, this system doesn't trade all the time. I think it's only active 45% of the time. It can also be used on the leveraged ETF equivalents like QLD and SSO, or I think UWM is the equivalent for the Russell 2000 small cap. But, you know, when you look at these systems, and when I tested these systems, I didn't test it over 5 or 6 trades. You know, I tested it over more than 10 years and looking at a couple hundred trades to see how it would work. And sure, you're going to get losing trades and you're going to have a losing streak. But over time, it's shown the ability to work. Now, I'm using 5-period RSI for the major index ETFs like QQQ and SPY because they're very broad, all right, especially SPY and MDY and IJR. So they're going to be a little bit less volatile. So 5-period RSI is a little bit more sensitive. It's going to move below 30 a little easier. All right, if I use 10-period RSI for SPY, it's not going to move below 30 as often. So when it comes to the industry group ETFs that I track and stocks, I tend to use 10-period RSI because those are a little bit more volatile than a broad index. Here's software. All right, it's been one of the strongest. Look at this advance. All right, we had a couple of sharp declines along the way, and we got RSI right to 30. I don't think it went below there, and right to 30 in December, and below 30 in March, and below 30 in June, and well below 30 now. So we've really gotten hit hard, and we're oversold. And so I'm looking for that move above 30 to trigger a mean reversion signal. And yeah, it's catching a falling knife. And I did a presentation, and it's called "Would You Have the Nerve?" Because it takes a lot of nerve to catch, you know, stick your hand out to try and catch that knife. Now that's why I don't, you know, buy when RSI goes below 30. I wait for it at least to bounce and move above 30. All right. The only thing I would be concerned about now is you've got a lot of pain out there. And as Tom was mentioning, you know, the market needs to find its footing. You know, it's kind of like the prize fighter gets hit with a left hook and is dazed and stumbles. Well, it takes a little while to regain your footing and stand up. And it looks like they're throwing out the baby with the bathwater today. So it may take a little while for the market to find its footing. But another one that I'm highlighting, and the reason I'm highlighting software and medical devices is they hit 52-week highs recently. So they're coming off of 52-week highs, coming off very sharply, all right? But they were the leaders in September, all right? And so IHI is coming into what could be a support zone in that 210 area. And RSI is below 30 for the first time since February. And look at that decline in February. All right. That would have been just as difficult, to time that bounce there. All right. So do we have any questions rolling in, Tom?
Well, I've got one for you.
Yeah.
And that question is, I know that the strategy is part of an uptrending ETF. But I guess my question is this: at what point, or what's your determination on what qualifies an ETF as one that's in an uptrend? So for instance, I mean, obviously the XLE has turned, but prior to this recent move to the upside, XLE was pretty, it was back and forth. There was a lot of volatility in each direction. I wouldn't necessarily say it was in a longer term uptrend like we've seen with software. And so I guess my question is, at what point do you look at an ETF and say, okay, this is in an uptrend. This is one of the areas of the market that I want to consider if I get this RSI to drop down below that 30 level?
Well, it's a tough question to deal with, but yeah, thanks for giving me the tough ones, Tom. No, it's a very good question. And what it is remember, everything is relative. There are dozens of actively traded ETFs out there. The sector SPDRs, the major index ETFs, the industry group ETFs. And so, when I was looking at XLE here at this stage, well, in August, it wasn't one of the better looking charts out there. All right. There were better looking charts out there. And so if you're, ranking your ETFs, XLE wouldn't have been in the top group in August. There would have been other ones that would have been on the radar, and that would have been where to focus on, ones that had stronger charts. Now, I just pretty much use like a higher high, higher low type thing, and 50-day EMA and 200-day EMA to determine the long-term uptrend. And, we did have a higher high here. And as I said, this correction went a lot longer than I thought. And, I was ready to throw in the towel there in August, and I did. And so I missed this great bottom here. XLE just pushed me just enough to get me like I'm fed up. And sure enough, once you're fed up, you get that nice bottom and that breakout. And it's hard to stick with these systems sometimes.
Yeah, I would agree, though. I mean, looking at that XLE off that top, it looks to me like you had those rising bottoms and the falling tops, almost like a symmetrical triangle. And that big move down did look like it was a pretty significant breakdown, though. I mean, I could definitely see where you would come up with that, conclusion and want to avoid it.
I hear you. Yeah. So thanks for sticking with me on that.
I'll follow you right off a cliff, Arthur.
Yeah, thank you. As long as we have a cooler full of beer.
Exactly. It's always a pleasure to have you on here, my friend. You share a lot of great information with us, and a calming voice to a very difficult market that we're all facing right now. So it's always great to have you on here, Arthur.
Great to be here. Thanks for having me on, guys.
So in the book itself, just so everybody knows, it's all stock charts. It's all stock charts, setups. But I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in stock charts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.